Can the Shriram Life Premier Assured Benefit Plan secure your family's financial future while guaranteeing financial stability in the long term? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what this policy is about. So, this is a non-linked, non-participating individual life insurance savings plan. And some of the key features of the policy are you can choose from two life cover options like Life and Life Plus, and you have flexible premium payment terms like single payment which is spread over 6, 8 or 10 years, and you have policy term options which range from a minimum of 10 years to a maximum of 20 years. You can also enjoy guaranteed benefits coupled with attractive returns. You can receive benefits in three flexible ways which are income, installment settlement or lump sum settlement, and you can easily switch your payout option at any time before the benefit payout begins. Now let us take a look at the benefits available under this policy. So first is the death benefit. So in case of the life option, the death benefit is paid immediately in a lump sum, and this policy will be terminated once the policyholder unfortunately passes away during the policy term. But if you have opted for the Life Plus option, then your death benefit is paid in equal monthly installments starting from the month of death of the policyholder till the end of the policy term, or which is subject to a minimum of 36 installments. So in addition to the death benefit, any income, settlement or lump sum benefits due from the date of death will continue to be paid as per the chosen payout option if the life assured were alive, and this policy will be terminated on payment of the last payout. However, the nominee have the option to take all the above benefits I have mentioned in a lump sum. Now, the survival benefit. The survival benefit is something the policyholder will get if they survive till the end of the policy term. So your annual payout as a percentage of the annualized or single premium are paid then from that policy anniversary after the end of the premium payment term till the end of the policy term will be paid. So this benefit is not available if the policyholder chooses the settlement option. Now maturity benefit is something the policyholder will get once the policy matures. So on survival of the life assured up to the policy term, then maturity sum assured will be paid. Like if you have opted for income or settlement in lump sum, then maturity sum assured is paid in a lump sum on date of maturity. But if you have opted for the settlement in installment option, then your maturity sum assured will be paid in 4 equal annual installment. The first installment payment starts on the date of maturity. So these are all the benefits available under this policy. What are the advantages of investing in this policy? You can avail loan of up to 80% of the surrender value under this policy. The Life Plus option includes an inbuilt waiver of premium feature ensuring income or maturity benefit are paid even in the absence of the policyholder. You can enjoy higher benefits by opting for a higher premium. The single pay option provides a guaranteed cash payout starting from the first policy anniversary. You can also enhance your coverage with 4 optional rider options. Now the disadvantages are survival benefits are not applicable if the settlement option is chosen. The life cover provided under this plan is insufficient. Opting for annual income benefit may increase unnecessary expenses, and this policy offers comparatively low returns to other options available in the market, and yearly withdrawals can hinder the compounding growth of your investment. So these are the disadvantages that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic understanding of how this policy will work, let us now move on to the analysis part of the video where we are going to calculate the internal rate of return IRR of this policy to evaluate the suitability of this policy. So let us assume that a 30-year-old male opts for this policy for the life option under this policy with a 15-year policy term and a base sum assured of 16,50,000. He pays an annual premium of 1,50,000 for 10 years. So starting from the 16th policy year, he receives 7,03,547 rupees annually for 4 years. The calculated IRR for this cash flow is 5.3 0.30%. So while this plan offers guaranteed and regular payout, the returns are relatively low and may not meet the expectation of most investors. Additionally, the periodic payout may be insufficient for substantial financial needs and could lead to unnecessary expenses. And the life cover provided is also inadequate to ensure the family's long-term financial security. So given its low returns, rigid cash flow structure, and limited life cover, this policy falls short as a viable investment option. Now, as we have an understanding that this policy is not giving us a desirable outcome because it is combining life cover and investment, which results in suboptimal return, we are going to explore a more effective strategy, which is to separate these components, life cover and investment, into two distinct products. So let's explore this alternative that can achieve the same cash payout and life cover as offered by the Shriram policy. So using the same parameters as the previous example, a pure term life insurance policy with a sum assured of 16.50 lakhs requires an annual premium of 8,000 rupees for a 15-year policy term with a 10-year premium payment period. This leaves us with 1,42,000 annually, which can be invested based on your risk appetite. For low risk investor, debt instrument like the Public Provident Fund (PPF) are a suitable option, while higher risk investor may prefer equity based options such as equity linked savings scheme (ELSS). For this analysis, both scenarios are considered. So for PPF plus term insurance combination, a minimum annual contribution of 500 rupees is required for 15 years in the case of PPF. Since the premium payment term is only 10 years, adjustments are made for the last 5 years contribution to meet this requirement. So the PPF matures at 29.74 lakhs. With annual withdrawal, the IRR is 6.62% as per the Shriram policy's maturity calculator. Now let's come to the ELSS scenario. So here ELSS plus term insurance combination, the pre-tax value of the ELSS fund grows to 49.18 lakh. After accounting for the capital gains tax, the post-tax value is 44.96 lakhs. With annual withdrawal, the IRR is 10.02% as per the maturity calculator. Both alternative mirror the cash flow pattern of the Shriram policy while offering better returns. Additionally, if withdrawals are deferred, the returns can be even higher. So when planning for life's financial goals, separating life insurance from investment proves to be a more effective approach. Now, then what is the final verdict on our analysis? Is the Shriram Life Premier Assured Benefit Plan worth investing or not? As you can see, this policy provides regular income or maturity benefit in installment during the final 4 years of the policy term, along with life cover throughout the policy's duration. While the cash payouts are guaranteed, they may not align with actual financial needs and could encourage discretionary spending. An evaluation of the return reveals that the policy delivers subpar performance with returns falling below the inflation rate. Its lack of flexibility in payout option and low return makes it an unattractive choice for investors, and it also has a high agent commission. Additionally, the sum assured under this plan is inadequate to meet a family's essential financial requirements. A pure term life insurance policy offers significantly higher coverage at much lower premium. Traditional plan like this one tends to provide insufficient life coverage and rigid payout structure, limiting their effectiveness in addressing the real financial goals. So it's better to avoid policy like Shriram. So a better approach would be to separate investment from life insurance. By doing so, you can build a diversified investment portfolio aligned with your risk tolerance, life objectives, and time horizon.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.